Break-even analysis is one of the most crucial financial tools every entrepreneur must understand. It answers the fundamental question: when will your business start making money instead of just covering expenses? Think of it as finding the exact moment your business transitions from losing money to generating profit. Understanding this concept will help you make smarter decisions about pricing, sales targets, and business growth strategies. Break-even analysis is a financial calculation that determines the precise point where your total revenue equals your total costs. At this point, your business is neither making a profit nor suffering a loss. You are simply breaking even. The analysis focuses on identifying how much you need to sell to cover all your business expenses. Once you reach this balance point, every additional sale beyond the break-even threshold contributes directly to your profit. Break-even analysis relies on three essential components. First, fixed costs are expenses that remain constant regardless of how much you produce or sell, such as rent and insurance. Second, variable costs are expenses that change based on your production volume, like raw materials and shipping. Third, revenue is the total income generated from selling your products or services. Understanding these three elements is critical because they form the foundation of your break-even calculation. Let me explain the difference between fixed and variable costs with practical examples. Fixed costs include expenses like rent or mortgage payments, insurance premiums, fixed salaries, equipment leases, software subscriptions, and business licenses. These costs remain the same whether you sell 1 unit or 1,000 units. Variable costs, on the other hand, include raw materials, production supplies, sales commissions, shipping costs, hourly wages, and usage-based utilities. These costs increase or decrease directly with your production and sales volume. The break-even formula is straightforward. Break-even point equals fixed costs divided by the result of price per unit minus variable cost per unit. The denominator, which is price per unit minus variable cost per unit, is called the contribution margin. This represents how much each unit sold contributes toward covering your fixed costs. Once you understand this formula, you can calculate exactly how many units you need to sell to cover all your expenses and start generating profit. Let me walk you through a practical example using a coffee shop that sells specialty drinks at $5 each. The shop has monthly fixed costs of $3,000, which includes rent, insurance, and salaries. Each drink costs $2 to make in variable costs, covering ingredients and supplies. The contribution margin is $5 minus $2, which equals $3 per drink. Using our formula, $3,000 divided by $3 equals 1,000 drinks. Therefore, the coffee shop must sell 1,000 drinks per month to break even. Break-even analysis provides 4 major benefits for your business. First, it helps you set realistic sales goals based on your actual cost structure rather than wishful thinking. Second, it enables price optimization by showing you how different pricing strategies affect your profitability timeline. Third, it provides essential risk assessment by revealing the minimum performance requirements to avoid losses. Finally, it supports strategic business planning by giving you concrete data to make informed decisions about investments, expansion, and growth strategies. Let me summarize the key takeaways from break-even analysis. First, break-even analysis shows you exactly when your business becomes profitable, removing guesswork from your financial planning. Second, remember the formula: fixed costs divided by price per unit minus variable cost per unit. Third, use this analysis regularly to set realistic sales targets and optimize your pricing strategies. Finally, make break-even analysis a routine part of your business planning process. By mastering this tool, you transform your business from operating on guesswork to making strategic, data-driven decisions that lead to sustainable profitability.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.